Well, perfect, because we'll go to the equities, the ChopSuey markets. It's been a chop market since our last event. A lot of the tech names have stumbled. NVIDIA, Microsoft, Amazon, Apple, they've all gone sideways till recently. I'll tell you in the last few days, Apple's, perked up, Google's perked up. NVIDIA just had their earnings today. On the surface, they look good. We'll see how that translates into tomorrow's market. Maybe tomorrow we break out of this range because the market's been stuck sideways. And so maybe the NVIDIA earnings are enough to push it forward. What's happened in this first quarter so far is a lot of rotation. When I say tech has lagged, that was leading, and then you had all the software names, the Salesforce, the Workdays, soft and SaaS names were the best investments over the last 10 years. And then one day everybody woke up and said, oh, this AI stuff is a threat. And you've had massive, like 30, 40% sell-offs in some serious names. In the Mag 7, Netflix is down 40. It's been for 8 months. Netflix has gone down. It's down 40% if you haven't looked at it. Looks like it might be changing right here. So you've had this area of tech that was leading that's kind of lagged, but the market didn't roll over. The generals got shot essentially, but the market didn't roll over. Small caps, energy, utilities, healthcare, basic materials, they all started to pick up the gain. So if you weren't allocated, like if you had your portfolio allocated like it was supposed to be in 2023, 2024, even beginning of 2025, where you're all Mag 7 or tech, you're really upset right now because it's gone down. And guys like us who saw it happening and transitioned into energy, utilities, basic materials, and natural resources, we're up double digits for the year. And the market's flat, essentially. So this rotation that we've been seeing is been helpful for us having a diversified portfolio, but it's been frustrating to the Ray J guys and all the other advisors that tend to be a little more buy and hold and not as tactical. So our theme going forward is we think you get some mid-year volatility. It's going to be a correction, not a bear market, the way it looks like now, unless there's a black swan event. And Iran does not count as a black swan event. We all see it. Black swan events, or it came from left field, had no idea what was going to happen. And then, normally in midterm years, you have some mid-year volatility. You got a new Fed chair coming in. They say markets like to test them. You got some stress and credit. If you've heard about like Blue Owl, and if you looked at that Oxford Lane, Justin, have you looked at that crap Oxford Lane Capital? We used to own it. Thank God we sold it so long ago. Paid a big dividend, and now is just complete dog shit. So in credit markets, you have this stress that's going on. So maybe that becomes a little black swan event later. But nonetheless, right now it looks like corrections, and then as you typically in a midterm year, you get to the end of the year, you have a little rally broadened out. So I think if you're a stock picker, if you're a sector picker, if you're tactical like us, you'll have a bigger advantage than if you're buy and hold. This is the S&P 500 over the last year. We showed this to you last month. This is January. We just talked about the levels that there's this short-term uber bull level that if we can stay basically above 6,700, the chances of getting to 7,000 and above were greater. If we broke below 6,500, then, caution, right? We have not broken below. Here's an update. You can see we've just really kind of bored everybody to death here. The levels really haven't changed. 67 to 6,800, 6,500 is kind of my bull bear line. We'll see how tomorrow comes, because if the earnings from NVIDIA are enough to keep the market up tomorrow and we close strong, there's a lot of things I'm seeing in the market that actually look really, really productive. And I've learned a long time ago, don't get too negative when copper and semiconductors, because they're the leading indicators. Semiconductors go into everything, copper goes into everything. So if those are leading the market higher, it doesn't pay to get negative. So right now, those are still the levels, but I warn everybody, we're in unprecedented territory. We are in very lofty areas that when the trend changes, you're going to want to recognize it early and be out early, because you can be down 20, 25, 30% in this kind of market really, really fast. And when, like I said here, when small caps and emerging markets and commodities lead the market while you're having little cracks in credit, um, that's usually late stage. You don't see that stuff early bear market. Um, so we just have to not be complacent. Our barbell approach is going great. I kind of went over this last week. I changed the things, like if it's in dark blue or bold, those we have a higher weighting in. So we love energy. That's been great for us. Utilities has been good. We scaled back on our traded REITs a little bit because of the interest rate concern last month. That concern is not there right now. So traded REITs are still fine. I'm just not adding to them. Tech, we lightened up because it's been in a correction. But right now, I'm seeing some of the tech names, they might be bottoming. And some of the crypto names might be bottoming, believe it or not. So a couple new things are on my radar after they've been through some pretty significant declines. Materials still look good. Healthcare still looks good. Financials looked great until this week. Like Monday, they broke below all their averages. Made me put out a note to our advisors that financials are. So unfortunately, because as the piggy goes, so does the poke, and they don't look great. On the emerging stuff, like I said, crypto's been going down for weeks, and today you had a big rally in Circle up 30%, a big rally in Coinbase, Robinhood, with a lot of volume. So these things look like they have either a tradable bottom. I don't know if it's investable yet. We'll see. We'll give it some time. Aerospace still looks strong because everybody's scared as shit of Trump. And energy, the new world of energy, like Constellation Energy, things like that, they seem to have turned around. And then the metals continue to be strong as the bar in the between. So this approach that we've taken has been very, very, very good so far. Causes a lot of day-to-day management, but we've been able to optimize where we need to be by really focusing on how things have broadened. Basically, this is in list of things that have performed great: energy, metals, commodities, the overseas and emerging markets. Justin, you mentioned earlier, chips and memory when it comes to tech. So you've had to get really specific in tech, not broadly. And then basic materials, healthcare, and I would say financials on the bottom list. I would, if I redid that chart today, or this slide today, I would remove it. But those have been the leaders, and they still look pretty decent. So, gentlemen,
one of the things on your barbell approach you didn't have, but one of the things on this one is a list of things that you do want, is overseas and emerging markets. So the international play, which we kind of alluded to in the beginning.
Yeah.
Last year was gangbusters. This year going gangbusters.
Yeah. This is where people as clients or individuals, you have to realize that you always have two risks. You have the investment risk, right? You have the investments that are in the portfolio, and then you have advisor or advice risk. We try and mitigate as much of both as we can with a process that's worked for 20 years. But this question that you're getting to cut down really dwindles down to the brass tacks. That it's a little bit of an advisor weakness. And in my career, like in my 25 career, there's been maybe 3-4 times where international markets performed better than the US. And in each case, they performed better for a very short period of time. if your time horizon is 10 years and something outperforms for 6 months, 8 months, I mean, it's like a fart in the wind. Do you really notice it? You might for a minute and you'd be like, but so from a personal advisor standpoint, I just have never put a lot of time and energy into finding good quality names there, because my attitude has been, why would I put time into something that doesn't happen that often? I'm going to work where I'm deserved, not where I'm needed. So now you come into a year like this year where international names have drastically outperformed the U.S. The difference is they haven't outperformed our portfolios. So even though we don't have international, we're performing closer to them than not. So we've been able to create that without having to go international. But right now, if I were to go international, I have done my homework. I'd look at Germany, I'd look at Japan. I wouldn't pick a broad international fund. I'd go and focus on a couple countries, Japan being one, Germany being one other. People can call me and I can explain why, because it'll probably bore you to death. So I think it's performing better now, but the reason we don't have them is they've never rewarded me that much.
My question, kind of to expand on that, is potentially, is this time different because of the change in tariff rules?
It's never different. That's a great question. Let me process. Is it different because of the tariff rules?
Well, with the blanket now, instead of the individual, which was probably a better approach, it's now blanketed across, which he says that's not gonna, he'll find other ways, which, he might not. But now you have countries that are getting away scot-free that, could do really well and expand that international approach.
Yeah, I'm not opposed to it. I think you're onto something. I would say that while Trump is in office, so this might be different. Where in the past there was 6 months, 8 months where they outperformed. Maybe with this administration and this environment, they get a 3-4 year stretch. If they do, we'll participate, because the move is early. Like the international stuff taking lead, taking spotlight has just happened within the last 6 months. Really come on people's radar the last 2.5, 3 months. So I'm not opposed to it. It's on my radar. I'm looking at things and thinking of watching them and saying, well, if they keep trading above their 8 and 21 day, maybe I need to bring them into the portfolio. So I'm not opposed to it. I mean, a good example of this is Andrew Walkman is watching, and one time, a couple quarters ago, we were doing a quarter review for him, and he said, I've been watching healthcare, and it looks like it's making a move, and I went on like a 5-minute rant. I hate healthcare. RFK is gonna, I went, but then after I did my rant, I thought to myself, well, I've learned about myself. If I go on a rant, I should probably go do more homework, because obviously, it's emotional or matters for some reason. And so then I started looking at the charts of, XLV and RSPH and a couple of different things. And I was like, holy shit, Andrew's onto something. and I was like, oh, you know what? And so, we brought it into the portfolio. So, sometimes, even though, there's some advisor risk, like I said, we try and mitigate it with being open-minded. So I'll bottom line this and then open it up for questions. Is bottom line on equities, trend is our friend. Semis and copper are leading, so tough to get negative. Looks like we just had a sideways grind kind of a correction. You get 2 corrections, down in price real fast or just grind it out over months, and that looks like what's been happening. I hope this week we break out of this stupid range we've been in. It does look like we could. And then, again, we're in unprecedented territory, so people should be careful up here if they're new. Keep an eye on the Mag 7, because they've been underperformers, but they might be starting to pivot. A few of the names, not all of them, but there's a few names in there that are really constructive. You can reach out to us if you want to know which ones. And I would say that watch the indexes, the levels that I gave you, 67, 68, 6,500, because the credit markets are giving us a little bit of watch out, beware the Ides of March. The credit markets are looking like they wouldn't mind taking Caesar out in the middle of the month. So that's why I gave it that title, because of some of the stress that's going on in private credit. I don't know if it'll actually trickle through and be a bigger problem. So it's on our radar as a concern. But at the end of the day, the market's been broadening out. Our barbell approach is working. We're being tactical. We're doing about as best as we can with the tools that we have. So, guys, before we go into interest rates and wrap it up, anything more on stocks, or does anybody else have any questions that you see in the chats?
I'm not saying I disagree with you on private credit, but on some of the things, I feel like the private credit has been noise because the Blue Owl, they sold all their stuff at 97 cents on the dollar. I mean, that doesn't sound like a huge, distressed sale, for that whole thing, for it to blow up and be such a big news story. So I think a little bit of the private credit stuff is potentially overblown. But there has been stress for years in the private credit sector anyways.
Yeah, I think you're dead right. I don't think they're canaries in the coal mine yet. Although I've got a little PTSD from the past that when I see these things, I go, the Blue Owl situation, they didn't distress sell anything, but what freaks people out is when you tell them you can't redeem anymore, like you can't get your money back. For a lot of people,
sale like that.
Yeah. So I just think at the same time you have groups like Citron, you have these hedge funds, and you have these people out there that retail investors. You who are watching the video here, you guys don't know this is happening, but every morning there's some Wall Street jerk off in New York that people follow. That's a hedge fund guy that has a following. And they put out a report, like what sold off software yesterday is, a report that was a thought piece. They said, "Oh, this could happen," right? And then all of a sudden, boom! The algorithms pick up and it starts selling off. So some of that's happened in private credit where it's noise. There's not a trigger, like we always have to do when you're watching markets, is you have to decipher what is the noise. And then while you're looking at the noise, you go, is there a trigger in that noise? Does it trigger an action? And right now, it's all been noise. So I think you're right, Patrick. I don't think it trickles over and causes the market to go down. If I did, I'd talk more about it. But, people like fear. Fear and greed sells.
100%.
Okay. Interest rates.